Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Confused on how to get access to higher-yielding bond funds? You're in the right place. Let's talk to the man in charge of the largest actively managed ETF in the world. Brian Lake is Global Head of ETF Solutions at JP Morgan Asset Management, runs the JP Morgan Ultra Short Income ETF, currently the largest actively managed ETF in the world. Also joining me, my old friend Tom Lydon from VettaFi. Brian, ultra short income, $22 billion in assets, corporate debt, duration of 1 year or less, but the largest actively managed fund in the world. I was really surprised to see that. What do you own, and how did this fund become so popular?
Yeah, well, Bob, as we talked about, the rising rate environment has been the story of the year. And so investors are looking for new tools in their playbook. JPST currently yielding 3.2% on the SEC 30-day, 4.4% on its yield to maturity. It's only got a duration of 3 months. And so investors are using JPST as a place to hide out while they wait for the market to find its footing.
So this is invest primarily in a portfolio of short-term, investment grade, fixed and floating rate.
Yeah.
Corporate and structured debt, and you're actively managed.
Yeah, absolutely. James McNerney is the person running this portfolio. He's the portfolio manager. He sits within our global liquidity book, and so you think about JP Morgan, you think about our Fortress balance sheet, and James McNerney sits within that global liquidity book. They also do our money market funds, and so he's a very thoughtful investor around this, thinks about the risk, understands exactly what investors are using with this money. This is their safe money. It's a step out of cash, and he's very thoughtful.
And you move in and out. You have dollar exposure here, so you move in and out, right?
Yeah, that's right. Yeah, some people use it as a long-term strategic. Some people use it as a way to take some risk out of their portfolio while they're looking for things to redeploy into.
Tom, what do you think of all this? It seems like investors are growing more comfortable with cash-like ETFs than they ever had before. I've been talking about these short-term duration products all year. I guess this is what happens when you got stocks and bonds down double digits in a single year. These ultra-short duration bonds look like a lot safer bet to generate yield.
Yeah, Bob, you're right. I mean, short duration money market funds, CDs, were basically dead money up until about a year ago. But one of the good things about the Fed's hiking rates is short duration or money market funds are actually paying something now. So that's a huge benefit. And when you look at that duration being 3 months and the active management component and specifically what JP Morgan is buying, you can actually have a really attractive yield. And when you look at the volatility in this ETF, it's basically flat. They've done a great job of maintaining that net asset value, which is also key and critical. So if you've kept your powder dry and you're looking for areas where you can actually make some money these days, it's a great opportunity.
This makes a lot of sense, Tom. I mean, historically, bonds compete with stocks. We forgot that, So if I can get a risk-free 2-year treasury north of 4% right now, that is actually pretty serious competition for stocks. It is. History shows that yields will rise as growth and inflation outlooks increase, so these short durations are a lot more favorable.
And on top of that, Bob, the Fed's been really clear about their path to the future. So when you look at the fact that, hey, rates are going to increase, and as they continue to increase and JP Morgan implements the strategy, continues to maintain short duration, but now has higher yielding instruments to work with, we could get this up to 4%, and it's like the good old days, right?
Yeah, well, there is an alternative. We used to say, Tina, there is no alternative to stocks, right. And now there is an alternative, right? So we have, that's why you're getting inflows into your funds.
If you think about historically, the risk premium for equities is about 4% plus a little bit of inflation, something like dividend. When you can get a 3.2 on the SEC or 4.4 like we talked about, that's actually pretty compelling. And if you're an investor looking at the next 5 years, maybe you want to take a little bit off and protect it in something like this that gives you that return without taking on some of that duration risk.
Yeah,
absolutely.
I also noticed your mixed managed, actively managed bond funds are really getting strong influence. So you have a core plus bond fund. JCPB is the symbol there. A lot of firms have these core bond funds that are mixed. This is actively managed, and you've got a sort of mix of investment grade, below investment grade, even distressed debt thrown in here. It's all actively managed. Corporates, there's some mortgage securities in there as well. So how do you do this? What's the you're dealing with tens of thousands of potential investment. What's the current mix? How does it look? How does this fund look at this?
Yeah, so this is ETF Edge, and so we have to acknowledge that a lot of investors think first about a benchmark or a passive instrument. But when you're looking at a passive kind of fixed income benchmark, that's not exactly how investors really think about investing in bonds. They want it to be a ballast. They want it to be something that gives them yield. They want it to be something that has a low correlation to equities. And so when you look at JPCB Core Plus Bond, it owns all of those things that can be the ballast in the portfolio. But exactly to your point, Bob, it can go to below credit. It can go to foreign investment grade bonds as well, which can actually help boost that return and gives you the opportunity to get additional yield.
Tom, how many years have we been saying this? The active guys come on and say, wait till we have a lot of volatility. My heavens, we're finally going to outperform. We know what the long-term record is of active managers. It's generally abysmal. And yet here is a year where we've seen a number of actively managed bond funds actually outperform somewhat compared to their passive investors.
The pendulum has swung, Bob, right? We're now in a situation where with these higher yielding instruments, and even some that are deemed somewhat aggressive, where you have managers who've been in place for a long period of time, they understand the markets, they can go in, and for these short-term durations, because they hold them to maturity, even though they might be deemed aggressive, they know exactly what yield they're going to get if they hold that to maturity. And as shareholders, from a diversified standpoint, we benefit from that higher yield while they're maintaining a balanced NAV.
Yeah. You know, we had the fellow who was doing single bond ETFs on a short while ago, and of course people are loving this 2-year because he has the on-the-run 2-year. So basically, every month they have a new auction. He sells the old one, buys the new one, and people are getting 4%, real 4% yields, unlike other people who own older bonds in their bond funds, and everybody is happy. Of course, if this changes, if rates come back down again, you know, that's not going to be so appealing.
Yeah, I mean, look, the ETFs are tools for portfolios, and there's probably a use case for those. But when we're talking about like something like Core Plus Bond, we have a portfolio manager that's intentional about what bonds they're owning, evaluating the credit quality, understanding exactly what part of the curve they want to be on, and they're actively managing that portfolio to position it to do what it's intended to do within the portfolio. And so that's why we're seeing people use this as a core holding to balance out their portfolio. And over time, I think that's important. Again, compared to passive, where you're just dictated by what the index does, you can float all over the place, whereas you've got a portfolio manager that's keeping their eye on what they're actually trying to accomplish in the portfolio.
Yeah, you know, another big fund with inflows this year that you guys are running, JP Morgan Equity Premium Income ETF. This is another one of those sort of mixed funds here. You want to own stocks in the S&P 500, but it's low volatility, and you get an income kicker. And I'm right reading this 12% dividend?
Yeah,
right?
that's right.
So you get these mixed funds now that try to get an income kicker on it. Explain how this works. First, you're in the lower volatility end, right? So you're looking at consumer staples names. You're looking at AbbVie, Hershey, Progressive, Bristol-Myers, Pepsi is what you own in here. So it's there you go. And there's Exxon thrown in. Yeah. And you also have the dollar thrown in there. But where do you get this 12% dividend?
Yeah, so I'd sum up the holdings that you just rattled off as quality balance sheets, right? We want quality balance sheets in this day and age. And so we own those names. A lot of those pay dividends, and so that starts to contribute to part of the income. And then it's actively managed by a portfolio manager by the name of Hamilton Reiner. He's been doing this for decades, and he's writing 1 month out of the money calls. And we're collecting premium on that, so that comes into the fund in the way of additional distribution. So you've got the dividend income and then the premium income from those options put together. Right now, it's yielding that 12% that you quoted.
Because the names you're talking about here, the consumer staples names, they're usually 2 to 3% typically. Yeah. That's a long way from 12% dividend yield here.
Yeah, well, but remember, the premium that comes from those options is dictated by the volatility in the market. Yeah. And if you look at this year, we've had volatility, and so that's pushed that premium up. And therefore, we've been able to harvest that 12%. Historically, we target about a 6 to 8% yield on this portfolio, 6 to 8%. Yeah. But because of the increased volatility this year, we're pushing 12.
So, Tom, this sounds like my God, how do I sign up for this? I got low volatility stocks, I got the S&P, I'm in equities, and I'm getting a 12% dividend yield. What could go wrong here? How could this whole thing change? It sounds kind of magical, doesn't it?
It does. It sounds like 60/40 is no longer on life support, right, Bob? I mean, the markets have come back in a decent way where there's good quality stocks with decent dividends. And now that we've taken our medicine on the fixed income side, we're also in a great situation where we can get some decent yields. So again, things are a little bit rosier today. A quick shout out, Bob. I loved your book party last week at the New York Stock Exchange. Again, congratulations. All your friends in the industry turned out. It was a great time.
Well, thank you. The 2.5 years in the making, and it was 175 people came, and it was half the guys on the floor meant a lot to me. I've been 25 years on the floor of the New York Stock Exchange, and after a while you wonder, what exactly have you learned working down here? So that's what the book is about. Anyone who's interested, shut up and keep talking. Lessons on life and investing from the floor of the New York Stock Exchange. I wasn't planning on a plug, but Tom's very good at that. He's very good at transitioning into these easy plugs. Thank you, Tom.
You deserve it.
Thank you. What's the criteria for inclusion here? So again, I get back to this miracle, this 12% dividend with all of these nice safe stocks that you own. Where could this kind of go wrong? If all of a sudden the volatility is lower, you're not going to collect as much premium, right?
That's exactly right. And you're asking the perfect question that I encourage all investors to ask is what could go wrong, right? And so exactly that, the volatility could come down and therefore we'd be collecting slightly less premium and that yield would come down along with that. We are, writing covered calls here, so we are giving up some of the upside on this one. If we go into a straight up market from here,
you're going to have to
leave a little bit on the
call,
table.
right?
That's exactly right. We're going to get called. That's exactly right. Now, the fact of the matter is that hasn't happened this year. We know that the primary benchmarks are down 20, 25, 30% in some instances, and JEPI is down 7%. It's an equity portfolio, and so that option premium also plays another role, which is it provides downside protection. And so, investors are saying, okay, I don't want to get completely out of equities. I know that's an important part of my portfolio. Maybe I'll own this portfolio where I can harvest some income. It provides a little bit of downside protection, and that allows me to navigate these tricky markets as well.
So what's the overall, if you had to describe where you're seeing flows, your client flows, you're JP Morgan, they've got a pretty significant business. What are they, am I hitting the theme right here? Short-term duration is sort of the big overall theme for investors?
You're hitting it right. So first of all, bull market, bear market, investors are always looking for income, right? That's always something that we see, that's perpetual. So number one, if you've got income, that's something that investors are continually looking for. Number two, when we've got this rising rate environment, you know that if you've got duration, you've got some duration risk. And so you want to pull that risk in. And now that we've talked about that the Fed has hit these new levels on rates, you're actually able to get something for that as well. And so absolutely, investors are bringing that duration in and doing it in that way. And then thirdly, with JEPI and JEPIC, its cousin, which is on a growthier basket of names, they're saying, okay, hey, maybe I can get a little bit of upside here, and particularly in a range-bound market.
Tom, VettaFi is essentially an educational marketplace for investment advisors. What are the RIAs telling you they want to hear? I mean, this must be tough for them. They've got clients, they're using ETFs, stocks down, bonds down, double digits, and their clients have got to be asking them what exactly they should be doing. What do they want to hear from you?
So the number one fear that they've had for the last 2 years is inflation. Talking to their clients about inflation, as now we're in the fourth quarter, how do you battle that? And as we continue to see rising rates, the good news, Bob, is we've got valuations in stocks that are really at fair levels. And when you look at areas overseas, especially in emerging markets, it may be generational buying opportunities. And on the fixed income side, kind of what we've been tackling here, yields are back. And yields are back to a level that are very attractive, especially for those in retirement or have retirement portfolios. So, hey, we took some medicine for the period of time that we're in. It doesn't mean that inflation's away. The Fed's trying to do its job. But also, there's a lot of tools out there, kind of like we've been talking about today, to fight inflation as well. So things are much better than they've been in the last year and a half. And with all the ETF tools that are available, advisors are getting creative, but still concerned about inflation, number one.
Yeah. It's interesting because we're acting like we could perfectly time the markets, in fact, and but we all know that it doesn't work that way. Market timing generally doesn't work, and the most important thing is to have a long-term plan. And perhaps we all were a little too much invested in stocks over bonds, and there are now attractive alternatives. So maybe some reallocation is appropriate, but I want to keep pointing out to most people that my old disciple, I'm a disciple of Jack Bogle, he always used to say, don't just do something, stand there. Sometimes it's better to do nothing. So I don't think anybody here is trying to advocate that we start trading around all of this chaos. It's a very difficult situation.
I think it's an important time for investors to go back to what's my North Star, what am I trying to accomplish with my portfolio, and am I aligned to the outcome that I'm looking for. I think one interesting thing with rates up is that the whole free money thing with rates at 0% has brought a tremendous amount of discipline into portfolios, and companies are having to run in a much more disciplined way right now. And so, again, we're not market timing here, but I think a lot of investors are dramatically underweight value. They might have gotten a little overweight growth over the last couple of years, and so thinking about maybe value. And I saw you guys showed the chart on Java a little bit earlier, which is our actively managed value fund, outperforming its benchmark, the Russell 1000 value, by 6%.
Well, the good thing about owning the S&P 500 is right now, of course, growth has become such a bigger part. Look what happened to energy, which is a classic value sector, for the most part. 3% of the S&P at one point. Now it's 5% of the S&P.
But I mean, if we look at all the tech earnings from last week, there's a lot of misses, and those had started to become some of the bigger names within the benchmark. And so it's interesting that these other ones are starting to crop it up.
The issue is a revaluation of growth finally happening. The value guys have been waiting a long time for that to happen. We'll see, but you can definitely see one of the reasons the earnings growth numbers for big cap tech are definitely coming down. And they're holding steady for some other sectors. Energy, industrials, holding pretty good.
Yeah, and these companies have physical things, right? Like they have oil wells, they have trucks that ship the oil. Like they have actually things on the balance sheet that generate this income.
Tech companies have intellectual property. They have software.
That's right.
That's important. So we can go on about this all afternoon. I'm going to talk to Tom about this a little bit more in just a couple moments. Right now, we're going to have to stop the show this week, ETF Edge. Brian and Tom, thank you always. I want Tom to stick around. I want to chat about ETF trends the remainder of the year and about the concerns about the buy and hold philosophy. Tom has some ideas on this on ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.